Back with closing trades right here, Nifty now holding out flat as we speak right now. Well, of course, there are names like M&M, the Adani group of stocks. They're the ones which are holding out. But that's not quite the case with some of the insurance plays, BEL, Axis Bank, L&T, Bharti, and some of the FMCG plays as well. That's where you're seeing some amount of pressure. SBI, though, has picked up a little bit, as has Sun Pharma. And then Unilever, DRL, Kotak Bank are also names which are also looking up right now in trade. And for the Nifty, it continues to be absolutely flat. But since Sunil Subramaniam as well joins in on the show right now. Sunil, hi, great to have you on the show. I think the debate is more about where's the safety next now that we've conquered that all-time high. And do you stick by with the large caps or do you diversify some into mid and small caps as well?
Well, I will diversify some into mid and small cap because I think what's going to happen is I think that the gradual return of the FI is happening in a very slow pace, but a trade deal announcement could make that gather pace. The second reason I expect FI's buying to pick up is because this is the period between now and end December is when hedge funds book profits. Now, obviously, they book profits in markets where they made profits, and India is not one of those. So I think our competing markets like China, Taiwan, South Korea are the ones which give them very good returns within the Asia emerging market pack, and hence there will be profit booking there. And India stands a decent chance of getting a portion of the fresh allocation because we haven't run up, right? And if you see the outlook, this quarter has been a indicator. It's been a tough quarter, but it's shown clearly that the second half can be better than the first. And for next year too, most brokerage houses are predicting at least a 14% to 15% EPS growth for the Nifty, which is a large cap. So while FII, I expect them to gradually start allocating more to India, though we are still not cheap from a valuation perspective. DII's behavior will be to sell the large caps into the FIIs and reallocate to mid and small caps in a greater way. And why do I say this? Is because there's been a huge run up. If you look over the last 1 year, I like to look at the 1 year data because there's a sharp polarization. And in the 1 year, it's been the DIIs who have driven the market. So they have had some favorite sectors and they have had some sectors they didn't like. So what have they liked? They've liked PSU banks. They've liked defense. They've liked the capital markets theme. They've liked auto because of the GST cut. And then to some extent some metals, right? So these are the ones which have driven the market to wherever it was because a small FII return made it touch lifetime highs. But what have they not bought? They have not bought IT, which is a big underperformer. They have not bought Realty, again a big underperformer. FMCG they haven't bought. So the point is that I'm saying is that given the relative valuations now because of the strong divergence in performance between the top sectors and the bottom sectors, I think there will be a reallocation by DIS. So when the FIS come back, they will sell back those which have booked profits. So markets will then remain in a consolidating zone with an upward bias. But at the same time, right, I think this is a crucial period when you can't expect a strong direction unless the trade deal happens because FII flows will be at the margin tending to positive, but not a big flow. So to me, then I see that this is a good time to reallocate from a pure large cap. If you look at it between large cap and mid cap, there's not been much difference in the 1 year returns. No? I think Nifty 50 is about 9 odd percent and the mid cap index is about 8 odd. It's a small cap which has really suffered because it's down about 3.5% on a 1 year basis. So which means it's almost a 12-13% underperformer. So I think the part of the reason for that, if I may also add, is the fact that earnings season wise, like large cap delivered according to estimates and expectations, high single digits. Mid cap did 34%, which was pretty decent. Small caps, though they grew about 18%, were underperforming relative to expectations because the valuations are obviously 30 plus for near forward P. So I think that disappointment is there. But in the next half year, I think the growth pickup will happen across small and mid caps, and the next quarter's earnings will support that. And in the consumption pack, it's only auto which has helped the consumption deliver some returns. So Realty, which is a part of the consumption pack, has underperformed. FMCG has underperformed. So now you and consumer durables also hasn't done as well except for the auto side. So you will see in the summer, you will see the cooling related refrigerators pick up. You will see that affordable housing will come through as the year goes by, and you will see a pickup in the real estate. So these underperforming sectors is where I see DIS now reallocating, and hence my favorite category at now would be the multi-cap category because it has to compulsory allocate 25% to each to mid, small, and large. And so that's the safety zone to answer your question.
Reallocation seems to be the key, Mr. Subramaniam. You did speak about reallocation from the DIIs to the FIIs from two large caps now and their foray into SMIDs. But within the SMIDs basket, talk to us about which sectors could see strength going ahead. You did speak to us about some of your favorite sectors. But what are some underlying themes that you believe are underplayed now and have more potential?
So I think that the biggest theme which is underplayed is the private capex cycle. And the reason I am so bullish on the private capex cycle after so many years of disappointment on that side is because this whole GST cut consumption boom, you've seen it in the auto space, you see it in part of the consumer durables, you'll see that the rest of consumer durables as the year goes by, is the rise in the revenue. That is the top lines. I think it's the bottom lines which people are not sure whether the margins have been affected or not. But I think that it's reasonably guaranteed that all the consumption companies are going to see good top line growth, which means capacity utilization in the country will rise up from the 76, 77% that has been stuck in for such a long time and will probably cross 80% in the next year. So when that happens, that's the trigger. If you see the history between 2008, 9, 10, 11, when capacity utilization crossed 80% is when private capex picked up. So I see that happening next year, and so that's not fully priced in. So for me, it's the entire infra pack, but with special attention to industrials, because private capex is different from government. Government capex largely relies on the building side of it, which is cement and steel and building materials and all of that. But industrial capex, which is the expansion of machinery and plant and machinery, that's the segment which I believe will lead the next leg of the medium term rally. And I feel that's not still fully priced in. So the broader infra pack, whatever comes in, and that's the same reason I'm bullish on PSU banks too, because they finance the MSMEs and the SMEs there. The only thing is, it's been the best performer over the last year. So to expect again another 25% return is probably, it'll still deliver healthy double digit returns over the medium term. So though PSU banks are not undervalued by any means from a last year's performance perspective, relative to private sector banks, they're still at a price to book discount. So to me, that's the two spaces which I believe there is potential for the market to grow in. When you ask me about relative valuations, and of course, the tariff impacted sectors, right? As and when a deal gets announced, and what you played about Mr. Agarwal's talk about it, looks like the deal is around the corner. Then all these tariff sectors which have been beaten down, textiles, leather exports, to some extent pharma, and IT has had this huge negative overhang on it, though it's not directly tariff impacted. So all of those also represent potential value buying opportunities for me. But the amount that you allocate to those, because it's a very big digital world, what do you mean that either it's one or zero, right? Either the deal goes through quickly or it doesn't and keeps getting stretched. So that's a risk there. So right now I would still allocate about 25-30% to those tariff impacted or export oriented sectors, and still keep my 75% around a domestic focused story around the industrials, the capex cycle, and the public sector banks.
It's okay. Hold on to that thought, Sunil. We're just going to get back to you and get in your opinion on the rest of the market too. But what is your sense of discretionary consumption? When do you think that will meaningfully come back and reflect into earnings?
No, I think that discretionary consumption as a top line, I think, is beginning to come back. Reflecting on earnings, I think actually because of the stock piling up, because it hasn't done well pre GST for such a long time, I think there is a tendency to offer greater discounts and get the stocks off the shelves, right? So I don't really expect a huge margin boost coming in the January quarter when you look at these numbers. But what's good is that a lot of their stock will move out, and these are high operating leveraged companies, right? So because of which you will see that while their margins may be compressing, on a bottom line basis, it will again help because their fixed cost gets covered that much, because they just need to get past the break even point. So overall, right, when you look at purely from a margin perspective, I do think that they will be little bit under pressure because of the competition and the need to get rid of old stocks. But EPS growths and the fact that they will now be well positioned to manufacture new products. And like I pointed out again, to me, the real story of discretion is going to lead into the private capex, because sales numbers, that is revenues, are definitely going to be really hitting through the roof because of the GST cut, festival season, and the fact that the youth are very now tuned to American things like the Black Friday and all of that.
As we run up to the Union, Subramaniam, weigh in here in terms of where the government capex is headed. Now that we're pivoting our focus more towards a consumption-based economy, and we were talking about consumption before this, where do you think, or rather, what do you think the role of private and government capex could be ahead of the budget, and any announcement, estimate if you have on that figure?
Been flat on the government capex part. It was on the 11 lakh crores. The reason is, I think the government has realized over the last couple of years, especially, that government capex is not leading to the adequate amount of jobs, adequate amount of money in the hands of the middle class. So they have shifted to a consumption orientation, both through the income tax cut that they did in the last budget and the GST cuts. So this new thinking of the government is likely to go through because they have realized that the capacity utilization in the country, right, has to be driven up, and that can be done through consumption. And once that happens, private capex will get its energy and then replace that. So I think the government last year got the mix right in their minds in terms of saying, okay, capex is a focus, but let's keep it stable, but let's increase increasing amount of money to what I would call as developmental populism, right, where you give the money, but that again goes back into supporting development in a way through the capacity utilization happening. So I think that this budget will strengthen that. So you might see a lot of incentives for private sector capex to pick up. I don't know in what form, in terms of tax breaks or maybe a renewed PLI scheme. So I expect that the government this time will focus its energies on sustaining its capex at the current levels, giving a boost to private capex, and giving a boost to private consumption. That's the new mantra I think that they will follow. And as far as the capex story is concerned, so private sector will have to take a larger burden of doing the capex part in the country. Also, they will try to help the states, because I think central government has generally been proactive, but the states probably are the ones lagging. And one final point on the capex, I think this has been talked about in the past, but it has not come through, is the public-private partnerships on the capex. Because as you know, a lot of the PSUs sit on a lot of land, they have a lot of resources at their story, but they just don't have the whatever you call the aggression and the ability to think long term in their businesses to really take advantage. So public private partnership, where the public sector gives its land as part of its equity contribution and private sector takes that up and goes forward, I think could be a big story in this budget if it clicks. So PPP, I think, will be the buzzword in this budget, hopefully.
Okay, fingers crossed on that. Let's just take stock of how we are winding up for the day and the week, in fact. Let's just bring up the over the week charts as well for the Nifty and how we've managed to perform. It's been a historical week in that sense. We finally made it to that all-time high and we are comfortably above that mark, but closing in around the 26,380 odd level for the Nifty futures. And for the week, we managed to put on about 0.5% in the green. The Nifty Bank as well had an all-time high, as did the sensex. So important to mark those indexes as well. For the Nifty Bank, it's been a solid move. While the start of the week was relatively quietish, and then midweek we picked up and we finally closed in with almost a 2% gain for the week. For the Sensex, it's been a 0.5% gain. Some of the other gainers, let's see what the IT index, what the auto index have been up to, because they also have had their fair share of contribution, as have financials too. The Nifty IT index pretty much in tandem with the banking index, 1.5% higher for that particular index as well. Auto is about a 1% kind of gain is what they've seen. And Nifty Finance as well has managed to eke out over a 1% gain. Kunal, do you think in the days to come, the sectoral composition would be the same? IT banks, are they likely to lead?
No, I think I think banks will be the one which could lead from here on. There is a strong rally which is coming back into the auto names. That's a strong sector which I believe could probably come back into a much more stronger breakout, because there are many candidates within the auto pack which are still looking very strong. There was a strong pickup of price action in the infra index. That's another index which I would believe could probably pick up pace, because as we see the markets getting a little bit more broad-based than what it was maybe a couple of weeks back, then you're bound to see some new addition in terms of sectors which could make a comeback. IT, I believe that the initial part of the move has happened. You could probably expect that many of these stocks may now go into maybe a week or a couple of weeks of consolidation before they gather momentum yet again. So I think for someone who's looking to buy IT, I would wait out for now maybe a couple of weeks or at least a 3 to 5% swing on the downside to try and maybe add or accumulate more.
Okay, that's on the outlook for IT. But Kunal, what about some other sectors that have not participated in the rally that we've seen this month? And those are names like Realty. Pharma has done pretty okay, but not all that great. Do you think it's time for some of these indexes to start picking up some steam, or still some consolidation underway?
Yeah, specifically on pharma, I'm very bullish now because I think for the first time, I think in the last many months, we are starting to see the large cap pharma names making a comeback. Over the last couple of days, I've been highlighting Sun Pharma as one of the picks because the stock managed to not just break past about the 1800 levels, but there's a golden crossover which has happened for Sun Pharma. That generally is a technical indicator which we look out for when the stocks are restarting or resetting a longer term trend for themselves, where the 50 DMA crosses above the 200 moving averages. We've also seen that happening for the likes of Lupin, where the stock has recovered from its last 1 month swing lows. The likes of Aurobindo Pharma, which has recovered I think around 10% or 15% from its swing lows around 1040-50 levels, and then Glenmark, etc. So there are a lot many pharma names which are making a comeback. What I like about the pharma index is large cap names like Sun Pharma, which are looking very strong. So which means that the leader from the entire pharma sector has started to show signs and now is on the verge of a big breakout for itself. That I believe could probably lead the entire pharma index. And also, I think when you look at this in the Nifty Pharma Index, on the charts of the Nifty Pharma Index, we are now coming back towards almost like a 10-month or 11-month breakout on the pharma index in terms of weekly closing. So that also I believe could be another positive for the pharma index. That I believe could be the other sector. Realty could take some bit of more time. I think maybe another week or so for the real estate stocks because the momentum seems to be missing out into these names. Maybe I think if there's some kind of a news flow which happens into the real estate stocks, that's where I would believe that you'll start to see momentum coming back. DLF, Godrej Properties, Oberoi Realty, these stocks have come back into a corrective phase, but maybe I think the bottoming out is still yet to happen for the sector.
Okay, that's the take coming in on the realty names and what the sectoral composition of the markets is likely to be moving on from here. But Sunil, within the entire discretionary pack, any particular sectors or stocks that you're liking?
I think that's time to start focusing on the cooling related durables because they have not really participated in the GST cut driven top line rally. And as the summer months approach now, I think that they will now play out the story strongly. So it's a good time to start accumulating those set of companies which are focused on the cooling area of consumer durables. The second is I still remain with a slightly longer term view bullish on the realty pack because the reason that the GST cut hasn't played out in the reality is because they're still focused on the demand side on the high end properties. But I think the real story which is going to be developing is the affordable housing part, where there's a supply issue because none of these developers have focused on planning projects out in the affordable housing space up to now. I see that gradually changing over the next few months. And with the drop in interest rates and RBI probably hopefully cutting rates again, the EMI leverage impact on the real estate loans, home loans, is the biggest fact. So I think that that will definitely play out next year. So again, as a contra pick, I know the technicals are saying that there's still some more downside, like Kunal was saying, but as a staggered manner within the overall discretionary consumption, I would favor the real estate also with a slightly longer term outlook.
On that note, appreciate you joining us today, Mr. Subramaniam. On that note, we'll let you go. Thanks for your time.